Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes. Today is the 18th of June, 2026, and my name is Peter Schaffrik. I shall be your host today. We have a very special edition coming up. We want to talk about the Fed, and we labeled it appropriately. Let's talk about Kevin. Rather than having multiple guests, we only have one today. We have our resident Fed watcher, Blake Gwinn, with me. Thank you, Blake, for joining us. And we really want to zoom in and dissect what has actually happened yesterday at the FOMC meeting and what to expect going forward. So, welcome, Blake.
Thanks.
Let's get cracking. And maybe if you start with a very easy one before we go into what actually happened yesterday. Can you just set us up? What did you expect going into the first Warsh press conference?
Yeah, that's a good place to start. I mean, the press conference, let me start with the dots, actually, because I think, when we look at yesterday, what really ended up happening was that Warsh almost kind of sank out of the headlines, and really what I think markets were most focused on was the hawkish shift in the dots. So let me start there. I think everybody kind of expected the dots to mostly move up to a hold, with probably 4 or 5, maybe 6 members now looking for a hike by the end of 2026. We smashed those expectations. We had 9 dots that were showing a hike. Some of those were showing 2. We even had one at 3 hikes. So a much, much bigger hawkish shift than was expected. I think on Warsh, it actually came in pretty close to what we were expecting. I did think markets might have been looking for a little too much dovishness from him, but it was kind of our view that, both to kind of maintain his own credibility, he didn't want to seem very out of step with the rest of the committee. Also, we've only really heard from Warsh when he was campaigning for, actively campaigning for the job, where we know he had to have a very dovish tone. And also those comments were speaking to his own views, whereas at an FOMC press conference, you are speaking to the committee. So we did expect it to have a bit of a hawkish tone. So that really didn't surprise us as much.
Okay, so let's dig a little bit deeper, if I may. So the SEP changes. What did we learn? I mean, you just said they were on the hawkish side, but what exactly did we learn?
Yeah, I mean, I think we definitely learned that a lot more people have shifted into a hawkish bias than we'd been expecting. I mean, I think looking at the Fed speak in the intermeeting period, you kind of know there's 4 or 5 or 6 people that, we know them by name just based on the comments they've given. Remember that we had 3 dissents to the dovish bias in the statement at the last meeting. So we know they were probably looking at a hike. And like I said, you had a few others that we know from their statements were leaning in that direction. I think what was surprising was kind of seeing the multi-hike scenarios and the fact that we got to 9. That really was a pretty big shift in the view of the committee. But, as to what we learned, I like one thing that actually jumped out at me, I'm not going to argue yesterday was not hawkish. It was unambiguously hawkish. But if we're looking for some kind of dovish threads or like a little bit of a dovish lining, it was interesting that shift in the dots is premised on a very lofty inflation outlook for the year. I mean, the core PCE forecast, the median forecast, went from 2.7 to 3.3%. That's where core PCE is now. So those hikes are basically, one way to read that is that those hikes are basically premised on not seeing any improvement in inflation by the end of this year.
Okay. So I'll come back to that later, and particularly sort of what it means for our views. But, we labeled the edition, let's talk about Kevin. So actually, let's do that. Let's talk about Kevin.
Yeah.
I mean, I was a bit taken aback by, him not submitting his own dot. And secondly, I mean, essentially talking the prominence of the dots and the SEPs down. So how did you interpret that, particularly him not supplying his own views?
Look, maybe I have a little bit of a cynical view on that. I mean, there's a pretty populist thread of hating on the SEP dots over the last 10 years, or when did we start those? Yeah, almost 10 years. I've been guilty of that as well. I mean, the dots can be very frustrating at times. So, I think when he was kind of campaigning for the job, if you want to call it that, it was a very populist thing to say, hey, these dots they've got to go. So it didn't surprise me that much that he didn't submit a dot. And it doesn't really matter that much in terms of the market. I don't really think so. I mean, look, we're going to find out what happens with the dots more broadly as these task forces come together. They have one that's going to look at communication policy. By the end of this year, presumably, we'll have some kind of recommendation on potential changes to the dots. But as of now, he said he's encouraging other people to keep submitting dots. So as long as we're getting all of these other dots, I mean, the markets are still going to have something to focus on. They're still going to have some idea of what the distribution of the committee looks like. So whether or not Warsh wants to submit one or not, I mean, the way I kind of look at that is he's really just ceding his guidance to the rest of the committee. I think that's true of the dots, but also, if he's not going to provide forward-looking guidance at the press conference and he's really not going to do that in speeches, we're just going to look to somebody else. Like, I wonder if there's almost a scenario where, maybe Waller's becomes kind of a shadow Fed chair in a way. If he's providing forward guidance and Kevin's not, markets are going to take that vacuum and fill it with something else.
Let me try to nail you down a bit. So he said, I think on 2 occasions, maybe even 3, we'll see in 6 weeks' time what's going to happen. Was he queuing us up here for a hike? And what is your expectation now as far as the actual policy is concerned?
No, I thought that was actually the absence of a message. That was his way of avoiding any type of forward guidance, was just saying, hey, we have a meeting in 6 weeks. You'll find out then. So I didn't see that as setting anything up. I really read that more as a way to not give any guidance. The times it was used, it was very much a dodge.
Okay. And what's your expectation now for the rest of the year?
So still on hold for now. I will say my conviction in that is a lot lower than it has been, but I still see a path there. But it's really on pretty thin ice. So we'll see how kind of the next round of top tier data goes.
Okay, we'll return to that in a second. But let me.
I thought we might. Yeah.
Let me just turn to the other major topic. Of course, is you alluded to it earlier. The task force, or forces, I should say, plural. So he will establish 5. Can you, just for the listeners, bring us into the know what it actually is, and then maybe share some of your views? What's the whole point of these operations? What's he trying to do?
Yeah, so I think the big ones, there were 5, but I think the big ones people were focused on were the balance sheet. Obviously Warsh came in with big expectations for kind of changing balance sheet policy. So this is kind of his way of starting that process. Communication, we already mentioned they're going to be presumably looking at everything, press conferences, SEP, use of forward guidance, the statement language. They'll be looking at all of those things and potential changes in the way the Fed communicates with the public. Those were probably the 2 big ones. We have one on inflation, and there were 2 other data sources and jobs and productivity. So those are the 5 task forces. I will say, it's kind of an interesting way to frame this, because all of these processes, in my view, have been constantly going on at the Fed. These task forces are going to be pulling outside experts, presumably from academic, from market sources, internal Federal Reserve experts, and convening them to discuss policies on these issues. But that is a process that's always going on. The Fed is constantly doing outreach seminars on balance sheet policy, for example, bringing in academics, sourcing them for ideas, iterating on how they handle the balance sheet. They're constantly, they have regular meetings with all manner of market participants to discuss balance sheet policies. Communication. There is a communication subcommittee, and long has been, on the Fed, that regularly convenes to discuss best practices on communication. So yes, it's a formalization of those processes and does give some explicit guidance on things they should be looking at. But I'm not going to pretend that this is something wildly new or radical. These are processes that are constantly ongoing at the Fed.
Did you get the call yet to come in on one of these task force? Going back to your roots.
I've been checking I've been refreshing my messages so far. No emails
okay.
yet. I'm sure it's coming. I'm just haven't gotten it yet.
So let me maybe put you on the spot a little bit, because one of the things you just highlighted, 2 of the big ones, and obviously for people like us, one of the key ones is going to be Fed communication. And I want to ask a double question, if I may. One, what did you make of the extremely shortened statement? Is that going to be a one-off, or is that going to be a regular feature now? And secondly, going back to the task forces, what do you reckon is, or it's hard to say, but what do you reckon is going to be the ultimate outcome of these communication changes that he clearly intends to do?
Yeah, first on the statement, I think it was some much needed cleanup, to be honest with you. There was only one line that was deleted that was really operative, and that was the dovish bias I mentioned some dissenters at the last meeting. That was the dovish bias that they had been against. That line was removed. That was really the only kind of directional, like communicative deletion. The rest of it was honestly, there was a lot of stuff in the statement that we just didn't need. It was just restatement of the Fed's goals, of the Fed's dual mandate. There was a whole line about we will continue to look at data and deciding what our next. Yeah, of course we're looking at data. Like we don't need to have that in the statement at every single meeting. So a lot of those deletions were just these kind of I don't know, like holdover articles from past iterations that have never been removed. I think the Fed might have been kind of worried that deleting some of these passages, even if they gave no signal and markets really weren't focused on them, I think they might have been worried that if they deleted them, it would send some kind of message to market. And so it's just picked up all this dead weight. This is a nice, having a new chair is a nice opportunity to just strike all that stuff. The markets aren't going to take any message from it. They're just going to look at it and say, okay, new guy, new statement. So I think they didn't have to worry about inadvertently sending any message by taking out a lot of fluff that was still in the statement. As far as the task forces, I mentioned that these processes are consistently ongoing at the Fed. And this is why I actually think that the changes that are going to come out of these are going to be much more marginal than people expect. Think about the dots. Like we're not talking about getting rid of the dots. I mean, at best, I think maybe there's some ways to water it down a little bit where they start giving different scenarios to take the weight away from this one kind of median point getting so much attention on balance sheet. Maybe we find a few tweaks here and there that we can run at 100, 200 billion smaller, which sound like big numbers, but in the context of the Fed's balance sheet are very, very small. And the reason is because, you're asking the same questions that they've been asking for the last 5 years. So I don't know why you would convene. Arguably, it's going to be, many of the same experts internally and externally that the Fed's already consulting with. If you're asking them the same questions, why would you be expecting a massively different answer than the ones that have already shaped where policy is today? So I'm not expecting these to result in very large sea changes, to be honest.
Okay, I want to nail you down in a second on the call itself, but I've got one question beforehand. Again, going back to the theme of let's talk about Kevin. You said earlier that it might be that he's ceding some of the messaging to some others. So do you think he's going to be, like from the very bit that, or little bit that we know, do you think he's going to be one of these super dominant Greenspan type chairman that everyone is looking at just the person and nobody else? And I know you beforehand you argued it's very hard to do because it's a committee. And so after you've now seen him in the flesh, so to speak, as a chairman, what's your take on this?
Well, one thing I do wonder if over the coming meetings we're going to see him soften a little bit on this very anti-forward guidance stance. I mean, we've gotten a little loose with the term forward guidance. I think forward guidance was originally referring to a very explicit policy tool, which is giving a pre-commitment to some rate path to move yields further out the curve when you're stuck at the zero lower bound and deliver some change in financial conditions. It's almost been broadened out to the point where, at least it seems in Warsh's definition, it includes anything that's in the future tense. Like he doesn't want to give any statement, any sentence that has any forward-looking component whatsoever. I wonder if he came out very hard on that, but as time goes on, that's going to soften a little bit. He's just going to find himself naturally talking a little bit more. I mean, it's very hard, I think, to talk about policy, to talk about the economy and not have any forward-looking component to it. So I do wonder if we're going to see that soften a little bit as time goes on. But if it doesn't, if he still is, really just not giving any kind of communication on where he sees policy going, where he sees economic data going, whether he thinks rates are restrictive or not, he kind of, said it's a mixed bag on that question. Like if he's not giving any of that, the markets don't just give up and say, well, we're not getting information from the chair, let's just move on and trade something else. Like we're going to look at somebody, like we're going to put more weight on, like I said, I can see Waller becoming more important. If he's out there giving us a framework and giving us a way to think about where the Fed's head's at, then we're going to start lashing onto that if Warsh isn't giving it. So that's where I kind of see things going if Warsh really does keep this hard line of just not saying anything in the future tense.
Okay, sounds like we will be speaking about Kevin after all for a while. Listen, very last question from my side. I mean, you said earlier you haven't changed your call. Very good reasons for that. You have said that you think policy is actually going to be on hold. That's obviously at odds with where the market was going into the meeting, and even more at odds going out of the meeting. So, and obviously there's conflicting forces. We got the MOU stuff driving markets to some degree, particularly over here in Europe, actually. So, what does it take for you to change your call and actually go with the market and forecast hikes? What would you need to see to change your call?
Yeah. So, I mean, before I even get there, I will just say one thing on kind of the market piece as well. I mean, I think, there's this separation between where I think markets go and what I think the Fed is actually going to do. Because even though, the call is still for the Fed on hold, my conviction in that, or another way of saying my conviction is low, is that the probability of a hike has gotten a lot bigger. Market pricing includes that probability rising. And so, I do think, I don't have a strong disagreement with the way that markets have moved. Maybe July is a little bit higher probability than I would assign. But if you look at the slope of the Fed funds curve, it's pretty tough to argue with that. And I think a flat Fed funds path, I think pricing in a perfectly flat hold for let's say a year is a very unnatural place for markets to be. I mean, I'm sure you probably see some of the same in your regions, but we almost always have a bias in one direction or the other. The market's either going to price in a probability of a cut or price in a probability of hike. And if you look back over time, the average Fed funds 2-year spread, it is positive, roughly like 40 basis points, right? So I think holding on to this hawkish bias, even if I'm right on this hold, and even if the Fed does not go and keeps kicking the can a little bit down the road, I think markets can hold on to that upward slope that's currently priced. So just want to say that up front. I mean, market pricing versus what I think the Fed is actually going to do, two slightly different things. But, to your question about what changes things. So, very near term, core PCE for June doesn't look like it's going to be helpful. Consensus is there for an increase. I think Bloomberg consensus was at 3.4. That's a tick up from 3.3 month over month, moving up a bit. So that's not going to be particularly helpful. But I do think if you look back to where we were at the beginning of this year, pre-Iran, there was this expectation that we were going to see inflation rising into the middle of this year, probably peaking around June and then falling in the back half. That wasn't just us. I mean, that was pretty broadly consensus. It was Fed forecasts. And I still think some of that might be in place. I mean, I think right now we are at peak fiscal impulse. We had the tax season, April 15th, our tax deadline here. A lot of tax refunds went out. That's still winding its way out of the system. We're probably at peak tariff impact on goods inflation right now. So there are some reasons to think that's coming back down. Now, the reason I mention all this is to answer your question of what could change that. If we don't see that improvement, I mean, if we go another month or two and not seeing any softening or any signs that turnaround and that pivot point is actually there, that's going to be problematic. It's tough to see an environment where the Fed doesn't end up hiking if we're not seeing that improvement. And back to a point that I made earlier, which is that their forecast for the end of this year is for no improvement. And if we start moving along that path, I would expect them to start hiking. So that's one thing, is just essentially time. If we keep moving forward in time and there's no improvement, at some point they just tip over. The other thing that I'm really kind of thinking about here in terms of what could drive a hike. This labor stability, like I'm not particularly bullish on labor. I think these NFP prints have been a bit of a head fake, and the labor market's not actually tightening as much as those would suggest. But you can't argue that it's stable. I mean, the labor market is certainly on pretty solid footing, even if, like I said, it's not booming. I'm not bullish on it. But what that means is the longer that goes on, the cost of giving a few hikes goes down for the Fed. It just gets easier and easier as those downside risks on the labor side decrease, to just throw in a hike or two. And I think the way that the Fed could frame that is that, last year they did adjustment cuts to protect against labor market rolling over. The labor market did not roll over, and now we're just taking back some of those cuts that we did last year. So I think they could frame it like that. And I think if the labor markets, if we keep seeing stability there, the likelihood of them just saying, hey, there's really no downside, there's really no cost to cutting a few times. It protects our credibility. Just from a reputation standpoint, we should drop a couple in. So again, this idea of just time going by without things really changing, I think could get us there. The last thing, that I think, I'm keeping an eye on is the AI story. If this just keeps barreling along, I mean, it's inflationary. I mean, we talk about productivity gains and that, Warsh uses that as kind of a way that maybe you could deliver cuts. That may be true in a year time, in 2 years time, but today it's inflationary. These companies are using up materials, using energy, we're hiring people to build these data centers. You're hiring people to build out AI infrastructure, business creation around AI, the CapEx, wealth effect from what's happening in stocks. All of those things could be putting more upward pressure on the demand side. And so, I think that's, I really didn't kind of buy into the Iran piece of it, but if that AI story, if that freight train continues to roll on in the next couple months and really look like more of a demand side problem, then that's something else that I think the Fed really has to hike to slow that down.
Thank you. I think particularly that last point, I couldn't agree more. Frankly, I think that's probably worth a full episode of Macro Minutes as well. But for today, I think we'll wrap it up here. I certainly think I've learned tons. I hope you did too. And if you really want to know even more, make sure to tune in again when we record the next edition of Macro Minutes. Thank you, Blake. Thank you, everyone, for listening, and speak again next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.